Welcome back to another episode. And today is kind of this new format that we're doing. So we are 4 segments. And today we're going to talk about market stats, Bank of Canada announcement this week. We have 2 guests. We're going to talk to a mortgage broker as well as an insurance provider. And then we're going to wrap things up with some of the legal stories and fun that we like to talk about sometimes.
Absolutely. Industry specials.
Yeah. And let's get to it. Market stats.
All right. So the average sales price for the month of August, we are sitting at $354,079, which is actually a 9.4% increase compared to last August. However, if we compare it to last month, which was July, last month we were sitting at an average sales price of $365,724. So we did actually decrease when you're comparing month to month.
Yep.
But when you're comparing last August to this August, there was actually an increase.
Yeah. And they're interesting numbers because July was actually the peak of the year for us.
Yep.
So will that end up being the peak of 2024? Only time will tell.
Yep.
But we were looking at 365. Now we're around 354. And year to date climbing number is at $336,356. So that number has continued to increase every single month for 2024. We know that we started back at 303,519 and we've continued to climb from there. So to see that we are year to date up to $336,536 is a huge climb. I mean, it's essentially a 10% climb.
Yes, absolutely. It is drastic.
With that, though, let's talk a little bit about the sales activity.
Yeah. So again, for the month of August, we had 183 homes sold, which is actually an 18.7% decrease compared to August of 2023.
Yeah, and what's interesting about that, if you look at the history of our August numbers, they have decreased for the last 7 years.
And it does make sense, getting back to school, all that stuff, everything is busy, so it is the norm.
Yeah, but it's to see that year over year continuing to decrease is interesting.
Yeah.
But what's been great is that over the course of 2024, because we've had such good months and we continued to have, we'll say, better than months of 2023, we are actually up 1.1% for the course of the year.
Yep.
So average prices are up, number of sales are up, and that actually brings us into new listings, which are up about 2.7% for an 1,887 listings year to date.
Yep.
But then that brings us to the list to sales price,
which we are sitting at, for the month of August, 105%. And if we look at the sales to list price ratio year to date, it's 104.9%.
Yeah. So we're holding pretty steady.
Yeah.
It's that the houses are selling over the asking price and consistently have been doing that all year. So it will be interesting to see what happens over the course of the next few months. And with these Bank of Canada announcements, we've just had another one this week. So will that affect our numbers? Where are things going to go over the course of the last quarter of this year? We'll be watching them closely and we'll be reporting that to you. So let's talk about that Bank of Canada announcement.
Yes. So if you haven't heard yet, the Bank of Canada has reduced by 25 basis points. And this is the 3rd consecutive reduction that they've done. So basically 0.75% has been swept off. And when we read the article and more information about it, what do we have there?
Well, what they're saying is that they are anticipating more of these. So, and it's great because our next guest speaker that we have, he'll be talking a little bit about what he thinks when maybe you should lock in versus not locking in and what's kind of going to take place over the next little bit. But Bank of Canada with this announcement had, I'm going to say, hinted that there is going to be more reductions, which again, our speaker, I think, will talk about that. But what I find interesting is that when you look at, I always like to put things in perspective for people. And when we do that podcast, that's what it's all about for us.
Absolutely.
So when you look at 25 basis points, what does that mean to a consumer?
Right.
Now, let's talk about it as if it's a fixed rate, because we all know that right away these announcements only affect typically a variable rate, those that are not locked into a rate. But those that are going to be renewing and things like that, we'll be talking about that again further in our podcast, but we're looking at about $15 per 100,000. So 25 basis points, you're thinking, oh, well, $15 per 100,000. Think of 300,000 for a house. We've already talked about the average sales price is closer to that 350 range, but 300,000 is $45 per month. $45 per month is around $500 a year. And let's kind of stretch this out a bit and talk about a 25-year mortgage, but you're looking at about $13,000 to $14,000 savings. So when you look at these numbers, I know no one's locking in for 25 years. It's not possible. But when you look at that numbers and look at what does 25 basis points plus 25 basis points plus 25 basis points, which is 0.75%, what does that mean for you? That's what it means.
Absolutely. Yep.
So I'm really excited to see that all of this is happening.
Me too. And I hope, like you said, with the hint, I hope it does continue to happen.
Yeah. And I'm even more excited to get to our next speaker because they are going to take us a little further in. We're going to talk about some intro stuff, intro questions for a first-time home buyer. And then we're actually going to close it out with him and talk about what should you do in these times with mortgages and with the rates coming down. Should you be locking in, not locking in? Where are we going next?
Yeah. All right, everyone, welcome. We have Jeff Cassidy here with us from Port City Mortgages, who is going to talk us through the pre-approval process, renewing a mortgage versus refinancing, and also kind of give us some insight to the rate predictions for the rest of 2024 and going into 2025. So welcome, Jeff.
Thank you for having me.
Yes, we're excited to have you.
I've been a mortgage broker for 32 years. It's the only job I've ever had, straight out of university. Still very passionate about it, and love what I do. Love helping clients, whether it's residential, commercial, just still very passionate about it.
Oh, that's awesome. That's incredible. So straight out of university into being a mortgage broker.
Yeah. The first company I went to work for was called the Equity Center, and it was in Vancouver. Probably employee number 7 on that list. And then I left after a couple of years to set up my own brokerage company. And then when I moved back to New Brunswick, I reached out to Grant Thomas, who owns the company, and it was an immediate sort of reconnect. That company's now grown to over 1,500 brokers nationally.
Wow.
And we've got 75 brokers for TMG in Atlantic Canada.
Wow.
And we got some incredible brokers here in Atlantic Canada that do numbers that rival, brokers across the country.
That's incredible. No, that's good stuff. So I guess the first question would be regarding the mortgage pre-approval. Can you kind of give us some insight to what that process looks like for somebody who's looking to begin their house hunting journey?
Yeah. Pre-approvals are very important for the broker itself, for the realtor, and for the client. Buying a house is very stressful, especially for first-time home buyers. There's lots of things that are going to go on in that contract, and it's going to happen in a very quick moment of time. So the first thing I try and explain to the clients is that the financing part can be relatively smooth. So I want to make it as smooth as possible, because when you see a property inspection report, you're going to see things that, they're going to highlight the things that are not good with the property. Now I try and explain to them that that's normal, and that's what you want that report for. So if I can make the financing side smooth, it just alleviates one layer of stress that, is going to be part of that transaction. The second time you buy a house, you're more comfortable with it. But especially on that first time home buyer.
Yeah.
Well, one of the things that I find really interesting, Jeff, and maybe you can talk a little bit about this, but with the mortgage pre-approval, you may get a pre-approval for yourself as a person, but then the next stage is the approval of the house itself. And it's a combination of those two items that bring the approval together.
Right. So on a pre-approval, there's some banks today don't do pre-approvals. They'll do what they call a rate hold. So They will just say, fire the deal in, we'll book the rate, and we'll look at the file later. One of the reasons being is that if a bank gets 10 pre-approvals and they fund on 2, that's not very efficient underwriting. So some banks just say, well, you know what, we're going to give us our best rate on the day that you come in with an offer. And if we're competitive, we'll win the business. And if we're not, we're not. So, and some banks will do a pre-approval and they'll put a hedge cost in it. So they'll say, okay, if the interest rate today is 3.69, then they may say, hey, we'll give you a pre-approval at 3.79 or 3.89. And then some banks will give you a straight pre-approval. The one thing you want to look at is, as I say, are there any elephants in the room on these applications? So, if I'm worried about credit, I'm going to talk about credit and explore that. If it's income, I want to know what the income is and I want to explore that. So I don't just fire in a pre-approval and assume everything is as the client said.
Right. So that would be the difference between a pre-qualification perhaps versus an actual pre-approval.
Yep. And in talking to the client, I'll ask us, a standard set of questions to drill into their income. Because in layman's terms, someone can say, I'm salary. And in the bank eyes, that's not salary. It could be the hourly, where you need 2 years of T4s or you get overtime bonus. There's a whole different, someone just works 40 hours a week and they think, okay, I'm full time. But the employment letter says that they're not guaranteed hours. So then if they've only been there a year and a half, then you don't have a 2-year average and now you have an income problem. So you want to address all those things up front. Some banks were willing to work with you and some banks are not. So if you have an income problem, you're going to, gear your pre-approval to the lender and say, hey, can you review these docs up front so that when you get the file, you're happy. So as a broker, as opposed to say a mortgage specialist or someone going into the branch, I have my own dedicated underwriters. So I deal with the same underwriter over and over. So if I have a query on income, down payment, I'll go to them right up front and say, obviously CMHC or Genworth is not going to review it, but we know what they're going to approve and not going to approve. And if there's going to be an issue. So I want to make sure the bank's on side. If the bank's on side, there's a strong possibility that the insurer will be. And so that's the key element. And it's also telling the client what the issue is so that they don't, feel that they're blindsided at the last minute when someone comes and says, oh, they didn't approve you because of income. And then you're like, well, why didn't you tell me? So the first thing I address is any issues with the file and just say to them, I think you've got a good probability this is going to get done. If it's a down payment problem, it could be the same thing. Walk them through the rationale for why the bank is going to say this is not acceptable, or find a different way to proof it up so that it becomes acceptable.
Well, I think too that when you can take those items that are conversation pieces that might be a little bit more challenging in the beginning, it makes for a smooth transaction.
Right.
Yeah. Upfront communication.
Yeah, is 100% key because you want to take that stress out of it and explain, there's a good probability this gets done. I just don't want to not address it with you. And then it puts them at ease a little more. Sometimes I'll look at a file and I'll just be like, we can try this, but it's not going to work. So let's go talk to your parents and get, a strong, co-applicant on the deal. And just explain the rationale why. And then I always talk to the parents and it's not like they're signing on for life. Usually if you get a parent to co-sign, the bank's fairly happy with the application to start with. They're just saying, it's not quite there. But if a year later, 2 years later, during the term, it's not like you're going to wait till the end of the term. You go back to the lender and the insurer and you say, are you happy to remove the parent? I've never had a situation where if the person that had the parent co-sign kept their job or kept their application basically the same as we presented it, 2 years later, they're always going to remove the parent. Now, if they don't qualify or their income hasn't got to a level that they thought it would or their credit deteriorated, that's a different story. But if you do as you say on that side of it, the bank's not looking to hold the parents there forever.
Well, what I'm hearing from you, Jeff, is that you are detailed to find out the right information to guide the client in the right direction. and looking to solve potential problems before they come problems. And
100%.
again, making things as smooth as possible. So with our clients, that's kind of the first home buyer that run into these types of questions. But we also have clients that maybe aren't looking to buy right now. They already own a home. And one of the big questions that we hear is refinancing a mortgage versus renewing a mortgage. And can you talk to us a little bit about the differences in those things and what the advantages or disadvantages may be?
Yeah. So there's a big difference between like a switch or a renewal, and a refinance or an equity takeout. I can't remember how many years ago, but call it 6 to 8. The federal government basically went to the insurers, CMHC, Canada Guarantee, Sagen, and said, you can't use our underwriting policies to take equity out of homes, because people were taking equity out of the house and using it like an ATM. Every time it went up $200,000, out came mortgage money. So the federal government was like, we're here to provide home ownership, right? Not lifestyle. So that changed the mortgage world considerably, because then you had something which was like called an insurable mortgage or an uninsurable mortgage. So if you just have a mortgage, 5 years later, you're looking for the best rate. Maybe you're looking for some different terms, but you're not taking any money out of the house. And then that is just a straight switch. So basically the lender just crosses out the name of the bank on the top of the paper. They register that with the like land titles, and they just switch it over, put the new bank's name on, the amortization, all of that, carries over. So it's a very simple legal process, and that's a switch. A refinance is where you're taking equity out of the property. So you may want to pay off debt. You may want to, go buy a cottage. You may want to top up RRSPs, tax-free saving. There's many reasons why you'd want to take equity out. So if you do that, essentially, then you get higher interest rates, because the risk to that lender is at the highest amount. So that's where loan to value comes in. So if you're taking out 80% of the equity, that's a higher risk proposition than if you were to take out only 65%. So those levels determine, where that's at.
So one of the big differences between the two of them is renewing a mortgage is much more simplified, but refinancing will require legal, because you will need to re-register. It might be perfect for someone who, even if there's a separation or divorce and one person's taking over the property than the other, that'll require a refinance versus a renewal. Which,
right. If it's a spousal, they treat those as purchases. So there's specific rules on it. But essentially, if a husband and wife separate and one spouse wants to keep the house, they will treat that as a purchase. So it's not considered an equity takeout.
right.
Now, you've got to be very specific in that agreement as to what can be paid out or included in the agreement. But that would be one of those instances where it is a refinance, but they treat it as a purchase.
Right. Okay, perfect. Was there anything you wanted to add to that, Justin?
No, I think that's great. I guess now, Jeff, if you could just give us some insight to what you think is going to happen with the rate going, like ending 2024, going into 2025. Where do you see the rate going? What are your predictions?
What does your crystal
This
ball
ball
say?
say?
Right.
I had a feeling this question was coming. So
Yeah.
and you hear it, you get this question all the time. And there's two sets of rates, essentially. So the Bank of Canada, deals with short-term lending, and the bond market deals with the long-term rates, whether it's 2-year, 3-year, 4-year, 5-year. Typically, short-term rates are less, or lower interest rate than long-term rates. Coming out of the pandemic, we've had an inversion, and it's the other way around. And essentially, that's just the market saying they think there's going to be headwinds into the economy, and we need a higher rate of return on short money. You're starting to see that ease now. So predictions would be, I think in the next over 2 years, the Bank of Canada is going to start reducing the overnight lending rate, which is going to affect variable rate mortgages. Quarter point here, you've seen the last 2 meetings, they've dropped 25 and 25. My prediction would be it's not going to be a straight, like 25, 25, 25. I think they're going to pause at periods of time and see where the economy's at and then adjust accordingly. But, over the next 2 years, I think you could easily see 200 basis points come off that. So, if you got a variable and you want to, ride it down over the next 2 years, I think it's a good place to be. You're starting to see the long-term rates are tied somewhat to the overnight lending rate, but it's more just an indicator of the economy. So in the last 2 weeks, the bond market has dropped 60 basis points, which is a big drop in a very short period of time. Some of that's come from weaker economic data out of the States and even Canada, which is good for the mortgage industry. But it's just a signal to say that, growth isn't that stubborn economy that we had isn't as stubborn as it was. Employment numbers have been less than what they thought they were going to be. So for interest rates, it's a good sign, right? It's going to, bring it back to where it was pre-pandemic. So I don't think you're going to go back to 2% money. But you could easily see.
Oh, come on.
I gotta kiss those days goodbye.
Yeah, I don't think so. But if you can get, 3.5%, 4% money in 5 year, I think that's where it's going to settle and be stable. Right now we're 4.69. I would not be surprised next week if you see more rate drops, because the 60 basis points that's come out of the bond market in the last 2-3 weeks is only being reflected on one rate drop of 10 basis points. So there is more to go there.
So if you were a consumer for a mortgage, let's just say a renewal of a mortgage. So you've already had a mortgage, you kind of have those low rates over the last couple of years, and your mortgage is up for renewal. And I know everything is based on risk tolerance, but what would you do? Not what are you telling someone else to do, because I know you don't tell people what to do, but what would you do?
Right. And I think on that point, I think it's good to talk about, like, pre-pandemic interest rates were 3.5, 3.75. So it wasn't until June of 2020 that those rates, just dropped. So the person that got 2% money, they don't have to mature until next August, September, October, November. So I think they're coming into a good period where obviously the rate's going to be higher, but they're going to be able to manage it, especially here in Atlantic Canada.
That's a great point.
Right. I think that's something to definitely look at, right? Then for people that are renewing now, they were coming out of 3.75 mortgage money, going into 4.69 or 7.9 now. It's not a massive difference. So it all comes down to cash flow. If you've got a lot of free cash flow and you're a risk taker, I would take a variable mortgage, right? But
that's what I'm in, but I've been in it for a little too long.
Yeah. So, I bought my house in the pandemic and got 2% for 5 years, 2.04, right? And I was like, I'm happy with that. Like, it's, some people were taking variables, and I was just like, I may not get the exact bottom of the market, but I'm good with this number.
Yeah.
Right. And now that, I've got that mortgage maturing next August, I'm looking at it and saying, if I can get if I got 3.5, I'll be over the moon. If I got 4%, I'd be like, okay, I got 10 years of money at 3% average. I'd still be happy.
Right.
I think it's setting the expectation of where you think interest rates should be on an average basis over time. And then look at it and going, 3.5, 4% is where the market is.
Okay. So what I'm hearing is, and again, based on people, they have different risk tolerance and things like that. But if you were renewing right now, you would probably go in a variable until the rates came down a little bit more.
And I would pick a target number. So I have a mortgage coming up in October of this year, and I'll go variable, but I'm not looking to stay with that forever. I'm just going to be, if I can convert that to 3.75, I will then just lock it away, call it a day. My goal on that is to pay it off in 10, 12 years anyway. So I'm just now I've got the interest rate set. I've just got to figure out the payment to get to that goal.
Right.
Right.
Well, that's great information, because I find that question comes up so much. I'm not a mortgage broker, and I'm sure, Justin, you get this question a lot because I know I do, but people are asking me all the time, what would you do with the mortgage rates right now? And which is another reason we wanted to get you in, Jeff, is because it's nice to hear that from a specialist in the field.
1,000%. Yeah.
And I would say, I mean, it does come down, like I always say, cash flow, because I always tell clients, I'm like, if it doesn't play out the way we think it is your life going to change, right? Are you still going to be able to go out for dinner? If the answers start to be my life changes, then I'm not recommending a variable mortgage to somebody in that situation. So it does come down to, free cash flow. And then asking, are you a risk taker or not? Because some people can have all the cash flow in the world, but can't sleep at night. And the same would be applied. Like, you don't need that stress in your life.
Right. Yeah.
Yeah, it makes a lot of sense.
Absolutely. No, I think that was very insightful, Jeff. Thank you so much for taking your time, coming on the podcast, answering those questions. And again, just giving some more clarification for people that are in similar situations, but just need a little more guidance.
Got it.
Yeah.
Well, thank you.
Thanks so much, Jeff. You're our first guest on the podcast.
Thank you.
Yeah. All right. Well, it was a pleasure. Thank you so much. And hopefully we can connect with you again soon. And
absolutely.
So, Jeff, do you want to give out your phone number, email, again, just kind of reiterate where you're from?
Yeah. So I've got Port City Mortgages in St. John. Website is portcitymortgages.ca. And phone number is 506-898-1600. And if anyone has any questions, feel free to reach out to me.
Awesome. Thank you so much. Jeff is one of the great go-tos in the greater St. John area for mortgages, whether it's commercial or residential. He has all the knowledge to be able to supply you with what you will need moving forward in your real estate transactions. So thanks again, Jeff.
Okay, thank you.
Hey everyone, and welcome. Today we have a special guest with us, Margot Hammond from Eastern Insurance Brokers. So Margot, can you give us a little introduction, and then we're just going to kind of go through and ask you some questions for clients that are inquiring about insurance and how much coverage they need and what different factors would impact the insurance and what that looks like on your end.
Absolutely. First off, thank you so much for inviting me today. I really appreciate it. It's what everyone wants to do on their holiday Monday, is spend time with you guys. So as you mentioned, my name's Margot. I work at Eastern Insurance Brokerage here in Rothesay, New Brunswick. We have offices in St. John, Rothesay, Sussex, as well as up in Bath. And so we service the entire province. I personally have been working in insurance since, well, it's been 14 years now. Odd thing, if you had asked me 20 years ago, I would have said, oh, you're crazy. But I really like to help people. And I realized what a great niche this is for me because it just feeds right into what I love. And from day one, after I took my first job in insurance, I haven't looked back. So I absolutely love what I do.
Wow.
Well, kudos for 14 years.
Yeah, and I took this position because I met a lovely man, moved out to Rothesay, and this position came available. So I live about 4 blocks from the office, so it's quite convenient.
Nice.
Wow. So a common question, basically, what do you need to quote a client's insurance policy? What is required from them so that you can do your job accurately and get them the best rate?
Absolutely. That's a really good question because that's going to vary depending on what someone's purchasing. So if you're buying one of these lovely new homes that are being built in all these great subdivisions out here in Rothesay and Quispan, I don't need a whole lot of information. Those types of clients, I'd really need to know if they've had insurance history, when they're closing, their names and dates of birth, because otherwise everything for the home, quite a given. Gets a lot more complicated the older the property gets. So that's really the big difference. The most important things to know about a home that you're purchasing, particularly if you're purchasing one that's more than 25 years old, is to know when the last time the big elements in the home were updated. And insurance cares about your heating, plumbing, roof, and electrical. Those are really big ones. I'll often get people calling for quotes and they don't know how many amps it is. They don't know if it's breakers. They don't know how the electrical is at that point. Any price I give them is not real. So those are the big important factors. The older a home gets, the more complicated and the more information I'm going to ask you for 100%. It's once you pass that 40-year threshold, I'm going to start caring about things like, have you ever had knob and tube wiring in the home? Are you guaranteeing me there's none left in the home? Is there any aluminum wiring? Is there any old plumbing, steel or cast iron? Those things will impact not only the price of insurance, but whether or not a property is even insurable. We can talk about those in a bit, the things that are the real red flags. I'm sure there's a question about that one too. Because
So,
there are some
Margot,
things that are, yes.
Margot, one of the questions that I have for you is, we a lot of times look to provide the listing information, property disclosure, because we know a lot of those things may be covering the questions that you're looking for to find the answers. So is there anything else that we can provide on our end, whether we are the buyer or the real estate professional, to give you to make your job easier?
Property disclosure statements are great. I do love when those come with it. They do make it a lot easier when I get to see exactly what it is. That is a biggie. And I would say of the quotes I do, I'd say maybe only 15% of the quotes I do am I ever even provided with one. So those ones, if realtors can provide those to their clients before they reach out, that really makes a big difference in what I can and cannot do and how quickly I can do it as well. So that is the big one, really, is those disclosure statements.
And I think they're so important too, because it just saves you from needing to ask us and then waiting for the response. When you just provide all of that information, you're getting 95% of the questions answered anyway.
Absolutely. And depending on which carriers, 95% can be enough for me to get a good price on a home. Absolutely.
And I find one of the big things on our end is there's a lot of questions, and sometimes even the homeowner doesn't know the answers to those questions. So when there's an inspection report, we can typically get a lot of those answers for the insurance provider at that time.
Yeah, and those are good too. Those usually do come, sadly, after I'm already, because most people reach out to me as soon as they make an offer. They're waiting for their inspection. So I do a lot of, I could say, half quotes where I go, okay, here's an estimate. When you get your inspection done, we'll reconnect type of thing.
Right.
So yeah, those are very useful too, definitely.
So once someone has the quote or has a policy that they know is going to be in place, what does the policy typically cover?
All right. So most regular, and I say regular, so we're just going to talk about sort of those homes where we have all the information, we know everything in them meets every company's okay.
Yeah.
So at that point, what you're really looking at, the two main important to me big pieces is the dwelling itself and your liability. So the dwelling is the building. So in the building would be anything attached to it. So your air conditioning, heating systems, all of those are part of the structure itself. So most homes are insured for full replacement. So basically, this can cause an issue sometimes for me, because one thing that's happening in New Brunswick, now we're starting to catch up, but I like to use my own home as an example. I bought a home when I was 26 years old. I paid $42,000 for it. Now, it was a duplex in the west side. We moved right in, tenants moved in, great. Each flat was about 1,500 square feet. When I got my insurance papers, at that time I didn't work in insurance, so I called them panicking, telling them, I paid $42,000 for this house, and they were insuring it for $359,000. And I wasn't in insurance. As a layman, I'm like, I only paid $42,000. This seems like maybe you're insuring me for too much. But now that I'm insurance, what they insured me for is, as she pointed out, if the house burned to the ground, are we building that house for $42,000? And I thought, well, no, you're not. This is so true.
Right.
So a lot of times, a lot of people ask me, where are my numbers coming from? So as an insurance broker, I look at the price of a property in a total loss. If I need to have someone remove that foundation, clean out the debris, rebuild the entire home, and replace your decking, your landscaping, all of that, that's what we look at. So it's nice when clients have a good expectation, particularly if clients that are buying homes that are pretty cheap. They need some work, but they're pretty cheap. When I look at that home, though, I look at the whole home. So even though I paid $42,000, it might be $350 to replace. So we look at a bit of a different number than property taxes or market assessments. Sometimes that's a shock value for some people who get a really good deal on a property in St. John that's old. But really, to rebuild what they've just purchased for $150,000 is probably going to cost me $600. So that's a fun one. The other big piece is your liability. A lot of people don't understand as a homeowner, all the property, your land, all your common areas, if maybe it's a commercial client, they're your responsibility. So if someone's injured on your land, and sadly, you own 200 acres, you own it outright, you tell me you don't want insurance. And I've had people do that. And I warn them, if someone gets injured on your property, even if they're trespassing, they can sue you and you can be liable for their injuries. So really replacing your home, your contents, and your liability are the big pieces. There's a lot more to it, obviously, but those are the bigger pieces that you want to make sure you have enough liability, enough coverage for your building to replace it.
Yeah. So, Margot, I just want to circle back to something that you said, and I'm going to actually get you to repeat it because this is really, really important for our listeners. And it's liability. Liability. So, why don't you just repeat that again?
All right. So the main important thing about the liability is as a property owner, you can be held liable for any damage to someone else's belongings while they're in your possession on your property or their persons. So as I did say, if someone trespasses, so if a snowmobiler decides they're going to go ripping through the Kingston Peninsula, through everyone's back, woods on their property, they hit a tree, and if it happens to be on your property, Sheila, and they're badly injured, you can be held liable even without giving them permission. If someone is injured on your property, you can be liable for those injuries and paying those people.
No, that's so important. I remember in real estate years ago, someone was looking at a house. It was a real estate agent, actually, and he was looking at a property and he sued the homeowner because he fell down the stairs. So
And he probably won.
Yeah, he did.
And if that homeowner decided, I don't need my insurance, the house is up for sale, my stuff's out of there, it's empty, that home would be the realtor's without any purchase, and that's what people don't understand. I had clients who did take liability off a 200-acre farm property they had, and they rationalized if something happened to the home, they'd move into the garage. I said, if I get injured on your property, I'm getting the house and the garage, all of it. They still canceled, but I did let them know you can't live in the garage if it's mine.
All our job sometimes to do is to educate, and then people will make, as long as we're helping them make informed decisions, that's the main thing. So We're talking about the insurance coverage and things to be aware of, but how we kind of talked a little bit about the coverage that you need in the sense of replacement cost. Is there anything else that we need to know to make sure that we're protected?
Absolutely. Here's the thing, when as a buyer, particularly if you're buying older properties, and as a realtor, if you're selling a client or helping a client purchase an older property, it's really important. Not all properties will qualify for the replacement coverage. If it is an older property, I can probably insure it, but if all those elements aren't up to date, then it won't likely qualify for that. If your mortgage requires that, you're not buying that house. So it's also important to figure out what you're purchasing, what are the insurance requirements for the type of financing you're getting, and then reaching out, really. It doesn't have to be me, but to a broker. Because if you call a direct insurance company, they're just going to say yes or no. If you call a broker, we're going to tell you here is why it's not qualifying. Here's what you can do to qualify. Here's what can be offered. Because oftentimes that's where the disconnect winds up being. The insurance required to close in the home, it just simply isn't available with the property that you purchased.
I remember, Margot, you and I speaking once, and you had told me a fun fact, and it had something to do with replacement costs, but it also had to do with the age of a home, being under a certain age, and then the replacement cost had a certain percentage above and beyond in coverage. Can you tell us a bit about that and why that's so important?
Absolutely. So replacement cost coverage, if you qualify for that, it's a guaranteed replacement cost. And this is why the mortgage companies want this clause in there. If I calculate that home Sheila is buying to be $500,000, and I have it insured for guaranteed replacement cost. Maybe she's living in Toronto and she just took $1 million mortgage. Very important to know that that property is going to be rebuilt as is, because it's only worth $1 million because it is what it is and it's sitting where it is. When I write my policy for Sheila, I give her that guaranteed replacement cost. And with that, there's a 30% gap. So if she has a total loss and something's happened, and now that house is really $1,250,000 to rebuild, that guaranteed replacement cost gives you a 30% gap that will guarantee we'll rebuild it. Even if we're off, we're going to do the 1.25 million. And this is why banks want you to have a guaranteed replacement cost policy, because of the volatility of markets, the cost of building supplies, overall inflation lately. It's something that's coming up more and more and more. And that's why they want it. They want a guarantee on their investment.
Yeah, it was such an interesting conversation with you, because it opened up my eyes as a person who saw, I purchased my house 9 years ago. And 9 years ago, I purchased at one price. My house is worth more than double that price now. And then it kind of was like, okay, well, where am I at with my insurance on my property? And then you told me about that wonderful little tip. And I thought, wow, what a great term to have in a policy. So thank you for explaining that.
You're welcome.
And now, Margot, I know that you had discussed obviously about the age of the home, different factors like the electrical, knob and tube, for example, the plumbing, but what would be, and those are probably some, but what are the most common factors that you see that affect the insurance policies?
Absolutely. And I'm going to hit these as the big red flags for me and the things that are most important when purchasing, particularly in a province like New Brunswick. And the reason I say that is something we forget that we are is the oldest incorporated city in St. John in Canada, and also one of the provinces with the oldest properties. The furthest west you go, the newer things are. So out in Vancouver, they don't have a wealth of buildings that were built in the 1800s. There may be a few smatterings, but not like here. So the big red flags are knob and tube. I do not have a single carrier that will insure knob and tube. I can get it insured, but the only way I can insure it is if Justin calls me and says, I'm buying this apartment building. It's got 3 units in it. There's some knob and tube in it, but I'm going to do renovations. The first thing I'm going to say to Justin is it occupied? And then Justin says, oh yeah, the tenants are there. They're going to live in there throughout the renovations. And that's when I'm going to let Justin know that I cannot offer him a policy. I do not have a company that will insure that property with people occupying it with knob and tube. Now, Justin says, nope, the building's empty. The tenants have already moved out. No problem. I can put that under renovation. If no one's in it, you're good to go. But that never happens. You guys know that as realtors. And most people who are buying a home aren't going to say, well, yeah, I'll do 3 months of electrical renovations, then I'll move in. So it's a very important thing there. Knob and tube is a no. If a client thinks they're going to move in closing day and there's knob and tube, really your job as realtors is to let them know that that's uninsurable. Mm-hmm. The other big one is high-tech plumbing. This is a plumbing used 80s, early 90s in that window. It's a predecessor of PEX. So I don't want people to be at all confused. PEX plumbing is a newer product, is an excellent product, not a problem. But its predecessor, which was high-tech, was constructed slightly differently with different materials. And the type of materials used in that had brass fittings. Basically with high-tech plumbing, it's just a matter of when it will rot and when the home will drown. So if a home has high-tech plumbing in it, I cannot insure it. And what's shocking is out here in the valley, some of the little garden homes down by the Gondola Point Ferry, some of them up in the Chapel Way, are high-tech plumbing.
Yeah, there was a lot of houses that were built with high-tech plumbing. You'll see pockets of subdivisions around the city and in Rothsay and Quispamsis that it was just kind of an era of its time. And then all those people, you'll find them replacing that at the time of sale. Where in the beginning, you could kind of get away with it. And now you just can't at all.
Now it's a hard no. And the worst is this. Some people, I'm sure, will be tempted, if they know they have it, to say they have PEX or copper. The thing I caution people on, great. But as a broker, I'm going to take that information from you. You're going to sign an application agreeing that's what's in it. So when the house drowns from the high-tech plumbing, guess what happens?
No
There is no
coverage.
coverage.
Mm-hmm.
You know, and a lot of times people say, well, can you pretend you didn't hear me say there was cast? And I'm like, well, I could, but then if I insure you and something happens, you have no insurance. So then we're both up the creek. So that's a hard one. Those are the two biggest ones. But again, I did touch on sort of those building elements, but another thing that is impactful here is everyone's worst enemy. It's water. So in New Brunswick, one of our biggest challenges here is how many homes we have on water and what water coverages exist. So when you're in a flood zone, it's going to be very pricey, and it's going to be pricey for very little coverage. I recently did a quote for someone who had sort of a stream, sort of not quite a huge river, but definitely like rushing water on the property. And for $30,000 in flood coverage, it was $968 just for that
Wow.
piece of the coverage. For sewer backup for them, it was over $500, and there was only $30,000 for flood and only $10,000 for sewer backup, and both with a $2,500 mandatory deductible. So that can be very impactful on choosing what you're going to buy. Because if you have a
Wow.
client that you're in an area where you feel it's potential that that home could flood and that home is extremely valuable, then as a realtor, it may be time to really discuss, look at insurance. What can you get first before making that firm offer and before making that commitment?
Yeah, I think one of the things, Margot, when it comes to insurance, a lot of times people will they'll remove the insurance condition out of the sale. And Justin and I are both big advocates on keeping it in no matter what. Because number one, if you're getting a mortgage, which most people are getting a mortgage on a property, there's not a huge percentage of people doing cash sales. It's required. It is required for mortgage. And then secondly, I don't want the shock factor to the client on what the cost is going to be for insurance. So we always keep that condition in our sale, even if they remove inspection, even if they're removing other things, because it is something that we feel is important for the client to acknowledge prior to closing and any hiccups.
And you know what? I'm going to give you a little example of why that's important. And for your potential clients, these are the type of realtors you want. I did get a call from a realtor on like a Thursday afternoon, day of closing. I tend to be the insurance girl that people run to day of closing, which is okay.
That's a great reputation to have, actually.
Absolutely.
You get
Doesn't
stuff
bother
done.
me. Totally. However, I'm on a conference phone call with the couple and they tell me the address and I pause for a moment and I type it in my computer knowing full well. So it pops up and then I have to explain to this couple who are 3 hours from closing and you after I give this can speak to what the impact is because I'm curious because I know there would be. They did not put an insurance clause in. They purchased a historical property in St. Andrews. They purchased the first archdiocese for the Catholic Church in Canada. So there is no one who can insure a building that's on a historical registry in 3 hours. In fact, if it's on a historical registry, it's going to take a lot of time because in order to even evaluate that home for reconstruction, you need to know everything. In fact, I don't touch homes that are on a registry or in covenant properties or in the zones in the Uptown St. John area and the conservation zones, because what's involved to insure one of those homes is astronomical. So what would happen if your client was 3 hours short of putting in their insurance papers on a $1.6 million home that they couldn't insure that day? What happens? Because I don't know.
Yeah, there would definitely be some factors there, but the best case scenario for everyone involved would that be that there is a delay in closing and that it would be pushed out and there would still be a closing. But it's also quite possible that there is no closing. And if there's no closing, then there becomes the who's in breach of contract, will deposits be returned? So there is a big domino effect in a very negative way.
I'm a big fan of insurance clauses, and I feel you're doing a good service to your clients. And I think it's a very important thing because or else you're going to be in a position of, maybe life gets busy for people. I don't know how you would ever buy a historic property and call 3 hours before closing, but I felt there was a lack of guidance all around for
Right.
that client and a disservice to them because it is an insurable property. It's a beautiful building. It's just not insurable in a day.
That's right. So the other thing that you touched on, which will kind of wrap things up for, because this is really what it comes to when it comes to, for the clients, or when Justin and I are giving advice to our clients, is that an insurance policy is only as good as the information you give to the provider. And you touched on that, but the whole purpose of having insurance is to protect yourself. So I know there's been instances where someone's like, oh, I just won't mention that. And it's like, well, no, if you have, there might be a hole in the roof or something, and they plan on getting it fixed, but they don't tell the insurance provider, and something does happen, well, then you have no protection. So because you have not given the right information. So when you were talking about that, that really resonated with me, because the insurance policy is only as good as the information given.
It is. It is. And some people, don't understand, but in the insurance business here, it's the same thing. You don't disclose. Not only do you put yourself out at risk, but you're also at risk of being canceled for non-disclosure. So if somebody had that hole in the roof, let's just say, and there was issues, it wasn't disclosed, but something else happened, a small fire in the kitchen, nothing to do with the roof. They come, they fix the kitchen, they see that roof, they realize they're going to cancel that person for non-disclosure. The last thing you want on your home insurance history is a cancellation by an insurance company for any reason. But for non-disclosure, it's not like auto insurance. Auto insurance is regulatory in Canada, and you are entitled to auto insurance. Home insurance doesn't work the same way. You're not entitled to home insurance. So you could put yourself in a position where you technically yourself would become uninsurable regardless of what you own, which means you're never going to own a home again. It's just not worth it.
That's right. Well, Margot, you have given us a wealth of information, and we truly appreciate you taking the time on your holiday Monday to spend some time with us and with our viewers, and so much for the public to know. I feel like insurance is one of those things that's overlooked a little bit in our industry, but so important in the sale of property and protection for future of protection of the of your asset. So thank you so much for your time today. And if you don't mind, I would love it, or we would love it, if you'd give your information again, just your name, contact information.
Absolutely. For sure. So it's Margot Hammond. I'm at the Eastern Insurance Brokerage here in Rothesay, New Brunswick. You can reach me at 849-3833, 506-721-7154, or margot.hammond@easterninsurance.ca. And if you want to pick up the phone and you just have general questions, you're not even looking for a quote, I'm always happy to help people on their journey, educate people. And as I tell my clients, if I can't find the right product for them, I do find them the person that has it too.
That's awesome, Margot.
Yeah,
Thank you so much for your time today.
Thank you guys. Have a great day.
You too.
All right, and we're on to segment 4 of the podcast today, which is talking a little bit about some legal complications that you could run into. And this one is triggered a little bit more by property lines and easements, whether you have them, don't have them. And I think you might have a little bit of a story for us.
Yeah. So I remember I had a client reach out to me. She was interested in a home evaluation, wanted to get her home sold, moving on to different things.
Yep.
So I remember feeling super excited.
Always.
Getting all the information together and getting ready for the appointment. But when I was on Service New Brunswick, pulling the overhead of the property with the property lines, I'm like, okay, this looks bizarre. It looks like the shed belongs to the other home on the other side of the property line.
Yeah.
However, you can see that it is, according to this layout, encroached on her property.
So probably most of the shed was on the neighbor's lot.
It was on
and
their
then
lot.
just some of it was over.
Just crossing that line. I would say 2, maybe 3 feet. So
Okay.
not dramatic, but
Right.
still there.
Yeah.
So when I went to the appointment, it was something obviously I wanted to
Have
mention.
a conversation about.
Yeah.
Yeah.
And when I brought it up with her, she had no idea.
Oh.
So then I'm like, okay, well, we know that Service New Brunswick lines are an estimate, so it's
Fair.
not necessarily accurate.
Yeah.
So my advice was to reach out to her lawyer
Yeah.
and get some options so we can kind of know what we're working with here.
Right.
Well, obviously, when her lawyer gave the options, they were, first of all, ask the neighbor to remove it.
Yeah.
That's the easiest way to go about it.
Yeah.
Get them to just push it over a few feet, and then we are good to go.
Yeah.
Otherwise, she could seek compensation
Yeah.
for them utilizing a piece of her property.
Yeah.
Or we could fully take it to legal, and which would be the more costly
Yep.
way to do it.
Right.
And by doing it that way, they would have to investigate the lines, get a survey, and then kind of rectify the issue that way. So once we had that information, I suggested, just to keep things easy
Yeah.
and peaceful,
Yeah.
the best course of action would be to have a conversation with the neighbor.
Right.
Just bring it to their attention, have the conversation, and see what comes of that. Thankfully, the neighbor was actually very receptive and easygoing,
Yeah.
which made our job a lot easier because you never know in these instances. Somebody
Right.
could be very in denial or unaware and not wanting to move it because it's been there for so long. But when he kind of knew that she was seeking legal advice and was given these options, but she was coming to him first to have this conversation,
Yeah.
he was actually very appreciative of that.
Well, I think one of the big things here with this conversation is that you found something that would have been an issue. First off, she purchased the property before you didn't know this
I
person.
did not sell
it was
this
before
property
you
to
were
her.
in the business.
Correct, yep.
So she wasn't aware of this. Whoever was doing the legal didn't see it prior to. And you were able to bring something to the forefront that if you would have been the buying agent on this, that you would have been bringing to the forefront. So not only did you help find resolution, but you've helped find resolution in the sale of her house that probably helped her gain extra money in the sale of her house because this wasn't going to hold it up.
Exactly.
Yeah.
And that's just it. What kind of rabbit holes could we have gone down
Yeah.
had this not have been rectified prior?
Yeah.
So
good on you for checking everything before you went to Service New Brunswick because it's easy not to do that. I call agents all the time and I'm looking at property lines and I say, oh, well, I see this shed and it's here. And they're like, oh, I didn't see that. So again, doing our diligence on this end can help in the long haul of things in the transaction.
1,000%. I think it's always important to do the investigating. And even if you're just coming with questions, you just want to get those answers
Yeah,
so you get
because
more clarity.
You could have brought that up to her and she said, oh, yes, I already know that. And that's fine. I'll take my chances with the sale. They might not care. And that's fine for me too.
Yeah.
So there's always lots of things, but our job is to kind of bring whatever information we can to the forefront.
Absolutely. So it was a totally good experience. They maintained a good neighborly relationship.
For as long as she lived there.
Yeah. Which was a hot minute.
Yeah.
But yeah, so no, it worked out in our best interest, but could have turned into something otherwise.
Yeah, that's right. Absolutely.
So yeah, that is my little story. So now let's turn it over to you for story time.
All right. Well, this one here, I'm going to start with a story where I had listed a property. It would have been last year. And we were in multiple offer situation. I think the house sold for approximately $40,000 over the asking price. So the buyer, felt that they paid a fair amount for the house.
Absolutely, yep.
Everything went pretty smooth in the transaction, so much so that the buyer's agent had complimented how well the house was ready at pre-closing inspection, one of the best she had seen in her years of business, and asked me
great.
to thank the vendors for that, which I did.
Love that.
Fast forward about 3 weeks, and the purchasers were doing some renovations to the home, and extensive enough, like ripping out walls and things like that. And along their journey, they get a phone call from their contractor saying that there's was water that was inside between the walls. There was also something along the roof line that they could see some foam insulation, and they felt as though the vendor did not disclose latent defects on the property, to kind of sum it up. And in this particular case, the vendors felt that they disclosed everything that they were aware of with the property, so much so to the point that they had actually had the roof replaced 7 years previous to that with a contractor. So they obviously spent the money to have the roof replaced. So if there was any issues with that, I think that one of the comments was, or a picture I received was, there was a hole in the roof. Well, if the vendor knew there was a hole in the roof and they had the roof done, they would get it done.
Yeah.
And then they thought that the vendor should be responsible for what could not be seen in between the walls. So first off, there was no inspection on the property. Number two, had there been an inspection, you're never going to see what goes on behind the walls. But if there was moisture, a moisture detector would have picked up on that reading.
Sure, yeah.
So anyways, they had mentioned that they were going to seek legal resolution. So what do you do as an agent and a homeowner at that stage of the game? Well, for me as an agent, I'm disengaging. You say legal, I'm going to stop my communication with you. That's what my lawyer is going to tell me to do. And I'm going to take all of that information back to the vendor and everything that I've gathered, and I'm going to give that to my seller because that's my job.
Yep.
And I did tell the buyers to reach out to their own agent to have any further discussion. After that discussion with the vendors, they decided that they were going to go ahead and take it to legal. They're okay with that. They felt that they were upfront and honest about everything. And the great thing in this scenario, besides the fact that it was probably frustrating and stressful, was that they did go to court with this and they won the case. So they did not have to pay out anything.
So your clients won.
My clients won.
Okay.
Yes.
Yep.
And obviously the judge didn't feel that one of the things that we've talked about is that a buyer needs to prove that the seller's knowledgeable about something if they're going to take them to court. And that's probably the most important thing as a buying agent. And I know I've told a story before where we're getting our ducks in a row to make sure we can prove that case if we're taking something to court.
Yep.
And in this particular case, it was just not provable because the vendors weren't knowledgeable. So that is another side. So I've told you a story of when the buyers have won. Here's a story of when the sellers have won that case. And the most important thing is to always be upfront and honest with your disclosures. And when you are, it will work to your benefit.
1,000%. You cannot disclose what you don't know, and somebody can try to prove that you knew something that you didn't know, but it's not going to work. So that was a jam-packed episode, from stats to mortgages to insurance to story time.
Yeah.
So thank you guys so much for joining us on podcast 16.
All right. Thanks for tuning in.
See you next time.
Bye.